Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. In today's video, I'll be discussing what has taken place since last week's video and its impact on natural gas. In my November 1st energy update, I said this year's fall low may be the last opportunity to hedge the cost of natural gas prior to pricing surging to a new yearly high in December. I based this on observations on past hedging patterns in 2000, 2002, 2005, and 2013, when natural gas rallied into the fall from lower pricing. And in each case, prices pulled back in October prior to rallying to a new high in December. In those four examples, the fall lows were reached between October 31st to November 13th. Therefore, I believe we may be reaching an important fall low this year in the first half of November. After writing last week's report, natural gas attempted a rally due to cooler than normal weather in the northern regions. But as you can see in this chart, natural gas is again declining and approaching an important technical indicator that in the past accurately revealed the fall low within a few days. The band you see enveloping natural gas prices is the Bollinger Band. Bollinger Bands are envelopes calculated as a standard deviation above and below a simple moving average. Because the distance of the bands is based on a standard deviation, they adjust the volatility swings in the underlying price. Bollinger Bands often help me to determine when a commodity's price is at an extreme and potentially ready to reverse. And the question is, was this tool helpful in determining the fall lows in 2000, 2002, 2005, and 2013? Absolutely yes. In the next four charts, I'll show you what happened in the past when natural gas prices declined to the lower Bollinger Band. As you can see, in 2000, the fall low was reached 7 days after declining to the lower Bollinger Band. And in 2002, the fall low was reached 5 days after declining to the lower Bollinger Band. In 2005, the fall low was reached also 5 days after declining to the lower Bollinger Band. And finally, in 2013, the fall low was reached just 2 days after declining to the lower Bollinger Band. Although no technical tool is perfect in predicting the direction of pricing, I believe this tool, in conjunction with what I wrote in my previous reports, leads me to believe we will likely reach this year's fall low within the next week or so. And although it is possible natural gas pricing may decline a little more from present levels, I believe the risk-reward of waiting for lower pricing is not wise. And I hope this report helps you appreciate the wisdom of protecting yourself now against the likelihood of higher pricing, not only in the near term, but most importantly, long term. As I've written in previous reports, this year's rally was primarily due to President Biden's administration's restrictive energy policy and the fear of inflation in the United States, along with a 10-year low in Europe's natural gas supplies caused by their green energy policies. And my concern is these policies leading to today's high prices are not abating. They are becoming more entrenched, and they're both here and abroad. No one knows for sure where natural gas pricing and electricity pricing will be over the next 6 months. But 3 years from now, I believe you will realize there was only one cost of doing business you could have stopped increasing: your cost of energy for natural gas and electricity. Hopefully today's video helps you understand the timeliness of hedging your gas and electricity near this year's fall low to protect yourself against the risk of higher energy pricing. And until my next report, please take care.